hope you're still awake to applaud me when I'm finished. Well, my name is Rita Reed. I am a CPA. I'm also an MBA, so I'm very well versed in putting together really big, long documents like business plans and writing financials, analyzing financials. I'm a CFO by training, and that's what I do for a living. I help businesses manage their money, organize their financial systems. So while I know absolutely nothing about the music business, I know everything about financial statements. So that's what I'm here to talk to you tonight. I guess I'm going to give you an overview of financial statements, why they're important in a business plan, what exactly they communicate to you, what what things you should look out for when you're building and analyzing your own financial statements, so that when you're looking at your business plan and when you get to the point where, I know some of you are already running businesses, but once the rest of you get to that point, you can have an idea of what the statements are actually communicating to you. You're supposed to use them as tools to help you run your business. Most people just get them in their hands and they say, oh, I got my statement, so next time around this time of the year when I file my taxes, I can pull them out and bam, here they go. Well, that's not really what they're for. They're really for communicating with your business. It's the only way your business has to talk to you and to let you know when things are going well or not going so well. So if I can leave you with a couple of things, that's what I want to leave you with. So let's get started. So in terms of the presentation here, we're going to talk about the purpose of business plan financial statements, because it's a little different from the financial statements you'll see when you're actually running a business. It's more of a synopsis, kind of quick and dirty, get to the point. An overview of what the financial statements are, a couple of examples, and we'll spend a little bit of time on forecasting and projections. Even though forecasts and projections aren't financial statements in themselves, they're actually derivations of financial statements and probably the most important part of the financial section of the business plan. So, the purpose of business plan financial statements. Well, I mean, it really depends on the pitch. If you're pitching for donations, let's just say you are a playwright and once a year or every once in a while you want to put on this play, and you just do it from the bottom of your heart, and you want to go on Kickstarter and you just want to raise, a couple $1,000s to put on your play. Well, you just want to give donors an idea of what a project costs, so that you can have an idea of what exactly you need to raise, what exactly they're contributing towards, and you can all walk away at the end of the day and say, job well done. If you're pitching for profits, which I think some of you are, if you're pitching for profits, you want to give investors an idea of what they will make first and foremost, because if they're not going to make any money off of this deal, then they don't want to give you money. Then they become more like a donor, and investors are not donors. Those are different people. They want to get an idea of when a project will break even. They also want to understand how quickly a project can scale. So how quickly will you go from selling, 1,000 concert tickets to 100,000 concert tickets? Help me get an idea for what your marketing is going to be, what your sales strategy is going to be, and how you're going to get me from the day when you're coming to me asking for money, and when you're going to start making money, and when I can get my money back times some multiple, which is usually, at least 2 to 3 times. So, again, the purpose of the business plan financial statements, it depends on who you're pitching to. Pitching to donors, they just want an idea of what your cost is, what your budget is. Pitching to investors, they want to know how we're going to make some money. We're going to target this towards, both. I mean, it can work for either case, but just understand when you're pitching to investors, the more details, the better. So I like to do it from a more detailed perspective. And if you're looking at donors, you can just condense a lot of this information, remove the details, and just move on from there. This could be on Kickstarter. This can be a person you had a good conversation with. They found out you were an artist and they want to support your project. It can be a nonprofit foundation that supports your type of work and just wants to see enough information to be comfortable that they're actually, paying for a project and not paying for, your light bill or your rent or something like that. All right? You're welcome. So, overview of the financial statements. There's basically 3 major financial statements. The balance sheet, and I'm sorry if I'm in your way, the cash flow, the income statement and the cash flow statement. The balance sheet is essentially a summary of financial position as a point in time. So balance sheets are done as of December 31st, 2010, as of April 11, 2011. So balance sheets are basically a snapshot of the position of your business at a point in time. What is your business worth today, right now, at this moment? The income statement is a summary of activity over a period of time. So the income statement tells you what your revenues and your expenses were over a month, a quarter. It could be a day. It could be as short as a day or as long as a year. So income statements show activity over a period of time. In terms of the cash flow statement, it's basically a business bank reconciliation. So you know how you have your own personal bank reconciliation, you have your checkbook, and you know what you started the beginning of the month with, and you know a bunch of stuff happened in between. You went to eat at a restaurant, you paid your rent, you went out, had some drinks with your friends, or I don't know how old you guys are, maybe you didn't, I don't know. You went out and had some lunch with your friends. Maybe you took a trip home to visit your parents. You know, all these things are in your bank statement, and at the end, you see this number, and for college kids, usually lower than what it started with. Right. So the same thing happens for businesses, except this time it's kind of grouped into categories. So just like when you pull some of your credit card statements, it shows travel, one expense, food, one expense, utilities, one expense. Same thing for cash flow statements. It's going to basically tell you where your money is really going. It's going to break it down between all the major categories of how you spend your cash. Is everyone clear so far? We're still together? Okay. Good. So the balance sheet, like I said, the balance sheet is a statement of financial position as of a point in time. It has three components: assets, liabilities, and equity. Equity can sometimes be referred to as owner's equity, shareholders' equity, partner's equity. That basically is determined by the type of business you start. So if it's a corporation, then it'll be shareholders' equity because you have shareholders. If it's just you, then it's owner's equity because, it's an owner. If you're an LLC and it's two of you guys together, you decided to do an LLC, then it's members' equity. But it always has the word equity in it somewhere. Now, the formula for the balance sheet is essentially assets equals liabilities plus equity. And the way it breaks down is what do I own equals what I owe plus what the business is worth. The way the formula really should read is equity, or what I am worth, equals what I own less what I owe. So that's the way you really should think about it, but this is the way the accounting textbook tells me to tell you. Either way, it doesn't really matter. Whichever way you do the formula doesn't matter. As long as it balances, we can all move on. But I just want you to understand how the numbers work, and we'll have some examples later. In terms of assets, assets are things that you own. You own your cash that's in the bank. You own the money that people owe you or your receivables. You own your equipment. Let's just say you are you're a guitarist. You go out, you purchase guitars and speakers so that you can put on concerts. Those are things that you have physically purchased, you owned. I saw the lady before me talked about inventory. That's also something that you own. You've produced that. I don't have it on here because, every day I buy things from iTunes, so I don't know who actually, physically holds CDs on the shelf besides Best Buy. But I left it off, but if you were to hold inventory, it would go in that asset section. Now, in terms of liabilities, think of liabilities as money that you owe. Think of it like a credit card. Liabilities is essentially a snapshot of your business's credit card. So who do you owe money to? Do you owe money to your vendors? I mean, if you sell T-shirts, if you went to the T-shirt shop and you placed an order for 10,000 T-shirts that you're going to pick up 2 months from now, you owe someone money. That's a liability. If you went to the bank and you borrowed money, you borrowed $1,000 so that you can pay for the T-shirts. Yeah. Now you owe the bank. So this is where this goes on the balance sheet. So anytime we're talking about things that you owe to whomever, to your employees, to your vendors, to the bank, that's a liability. Equity. Like I said, equity, it depends on what type of company you have. If it's a corporation, it's shareholders' equity. If it's a sole proprietorship, owner's equity, LLC, members' equity. But essentially, this is the investor's share of the business. This number can go up, it can go down. It is basically a reflection of what is left if after you paid all the bills and you paid everything that you owed everybody, this is what that particular investor's share of the business is worth. Yes?
I have two questions.
Mm-hmm.
First of all, in the assets, what determines, in terms of a corporation or an LLC, what determines a personal asset versus the company's asset? Like, if I bought it out of my bank account, of course, it would be my personal asset. But what if we went bankrupt? Would it be seized by?
Well, you have to admit it into the LLC or admit it into the company. So just because you bought it and you own it doesn't make it an asset of the business. That's a really good question. So it has to be admitted into the business. So how would that happen? Let's just say you have all this, you have these instruments lying around your house. You and your buddies get together, decide to form a band, and create an LLC out of it. And I contributed a piano. What's your name over here? John contributed a guitar, and what's your name? Professor Snyder. Professor John Snyder contributed the drums. So we're all going to contribute our instruments as equity to the company. So we're going to have an asset called equipment, or keyboards and drums and guitars, and then that's going to be the basis of our equity in the company.
So that's essentially collateral.
It can be used as collateral.
That's bad.
Yes.
I don't like that. Okay.
It could be, but it doesn't have to be. Banks don't like.
Unless you put it up as collateral.
Would if you die and it's collateral that can be seized, right?
You're talking about an asset of the LLC.
Right.
Right. Well, that's owned by the LLC.
Right.
Right. So the LLC gets sued, and that asset could be used to satisfy the judgment.
Absolutely. Yeah, that's what I was getting at.
Absolutely.
And my other question was, what is the difference between working capital, retained earnings, and revenue?
Okay. Well,
Revenue, but I guess working capital.
working capital is essentially, it's a measure of liquidity. So if you take your cash in the bank plus the people who owe you money, less the people who you owe money to this month, that's essentially your working capital. So that's the amount of cash that you have on hand to essentially run the day-to-day operations of your business. So how much money do you have available to pay your creditors that are due this month? Like, so think about your Visa bill, right? How much money do you have on hand this month to pay your Visa bill? How much money do you have on hand this month to pay your light bill, to pay your rent, to pay the things that you have to pay month to month? So that's your working capital. We're not talking about what's going to happen 10 months from now, what's going to happen 3 months from now. So what do I have on hand right now that can cover my bills for this month?
And that doesn't include outstanding liabilities that haven't been paid yet?
If it's a liability that hasn't been paid yet, then your working capital is basically, like you basically want to take your assets, your cash, mainly, your cash plus receivables that you expect to be collected this month,
Right.
less the liabilities that you know you have to cover for this month. And then that's essentially your working capital. That's the money that you have to cover the everything else.
So it's like on a time basis of receivables minus
Exactly.
outstanding liabilities. Okay.
Exactly. And then retained earnings is essentially, like I have at the bottom, it's a bucket for all of your income. So all the income that you've earned over the years, over the months, this is how the income statement and the balance sheet interact. That last line, net income, essentially flows through to the balance sheet and becomes retained earnings.
So I guess my question was, what's the difference between retained earnings and profit?
Retained earnings and profit. Retained earnings, just think about the word retain, right? So earnings, profit, retain, all of my profit, right? I'm retaining my profit. So I'm going to throw all of my profits into this bucket, and that's your retained earnings. Whereas profit is typically a measurement of what did I earn this period. So that's the difference.
Okay, that makes sense.
Okay.
Thank you.
You're welcome. Yes.
Do you do that, the stuff with the 30 days, is that done like per billing cycle, or is that, you can look at that like every single day?
What
Like
for 30 days?
People that I owe money to this month,
Mm-hmm.
is that? Like
30
you
days,
said,
yes.
I pay all my bills like on the
Mhm.
first.
Right.
Or the second.
Mm-hmm.
So I would do that on the first.
Right.
And then would I do it again like on the third?
You would, if you're running this, it depends on how sensitive you want your model to be, right? If you want your model to always count 30 days forward, then you can have your model to adjust to count 30 days forward. But it's usually okay to say, what do I expect this month? And this month meaning in the next 29 days, in the next 30 days collectively. And then once I finish with this 30 days, then I'll deal with the next 30 days. So that's probably there are some businesses where I would say absolutely not. You need to look at it on a day-to-day basis, but this isn't one of those businesses. You know, construction would be one of those businesses, right? You have labor, you pay them daily, so you really need to understand what your cash position is and your liquidity every single day. In this particular business, most likely you're going to pay per concert or you're going to pay per CD that you produce. These aren't things that are going to happen every single day, so usually a month is sufficient. All right? All right. So I think we've kind of nailed the balance sheet here, so we'll move on to the income statement. And this income statement is a statement of financial position as of a period of time. So the gentleman back here wanted to know more about periods. What differentiates a retained earnings period from an income statement period? An income statement is usually just one period. It could be a quarter, it could be a month, it could be a year. Retained earnings only close out at the end of a year. So it's not really a collection of everything that's happened in the past couple of weeks or the past couple of months. Retained earnings don't really capture the previous year's income until the next year starts. So on Jan 1, 2011, retained earnings is going to pick up whatever we earned for 2010. Okay? All right? Yes?
Should that first sentence read statements of financial position as of a period in time or point?
Point.
I thought
you know what? That must be a typo. I'm sorry about that. It's actually a period in time. So make that correction. It's a period in time. And there are 4 components. Basically, the gross profit section, which is probably the most important section. Revenue, expenses, gross profit, that's sort of the top bucket. So it's kind of broken out into sections. You have your operating expenses, which are also referred to as overhead. You have interest and extraordinary items. So let's just say, I don't want to use horrible examples, but let's just say I lost a whole bunch of money due to a hurricane. And I don't usually lose money. I'm usually profiting. But in this particular case, I had to incur all of these additional expenses. I decided to pay my workers for a couple of months because I'm just a nice person. I did all these things that I don't typically have to do. So that's an extraordinary item. Net income is what happens after you subtract all that. So, and taxes I have kind of in brackets after that because taxes is what happens if you make money. So taxes are debatable, right? You only pay taxes if you make money, which is why it's not necessarily a requirement on the statement. Particularly for your business plan, I would just end it at net income. Honestly, taxes are a completely different ballgame. And you have to have a skill set that is far beyond what I can teach in one day in order to project taxes. So usually you just leave it at net income, and as long as you show you're making income, the assumption is you will have to pay some taxes. Yes?
For the business plan, it's kind of hard to make a group financial statement because it's totally in the future. So wouldn't it be better to make a pro forma financial statement where you project everything in one spreadsheet?
Oh, I'm getting there. I haven't gotten there yet, but I'm coming to that. But the income statement is the basis of your pro forma, right? Your pro forma is your income statement. So what you're going to do is you're essentially going to give a balance sheet. You're not going to really project a balance sheet as of the end of year 1. You're going to project income as at the end of year 1, income for year 2, income for year 3. Your balance sheet is essentially going to be what are my uses of funds? And what is this business going to look like essentially on day 1? So what am I going to spend all this cash that you're going to give me? What am I going to spend this cash on? So that's what they're looking to do, more of a sources and uses of funds than actually projecting what inventory is going to be at the end of year 1. What are my liabilities going to be specifically? If you knew that, then you would go play the lottery, right? I mean, we're good, we're smart, but we're not that good. So usually, like you said, the pro forma is the better thing to focus on for the business plan, but in terms of the balance sheet, you do want to understand what your day 1 balance sheet is going to look like. What kind of equity is coming in? What assets are you going to own as of day one? The investors want to know, particularly if you're going private equity or mezzanine, that's a loan, right? So they want that to be acknowledged on the financial statement, on the balance sheet, acknowledge that you owe me money. So they're thinking about day one, not day 31. For the performer, they're thinking about day 1 through day 700. So that's the better place to really break out what the sort of specifics of the business are going to look like, more from a revenue and an expense standpoint. Does that make sense?
Yeah, that makes sense.
Okay. All right, so in terms of the formula, gross profit, which is also referred to as margin, equals revenue minus production-related expenses. So production-related expenses means I don't incur any costs unless I actually produce something. So if I don't produce this concert, then I don't have to pay the doorman, unless your contract says that you do. But generally, if you don't have to do this, and you only incur this cost if you actually produce something, then it's a production-related cost. If you have to pay it regardless, you have to pay your band manager, a fee, a salary, regardless of whether you book an act or not, whether you're booked as an act or not. That's an overhead expense, right? It's something that's lingering over your head, regardless of whether you make any money or not. But a production-related cost is something that you only incur if you actually produce something. So those two are netted together, revenue and production-related expenses, which is also called cost of goods sold, and that creates your gross profit. That's a very, 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 very important number for your business plan. All right? You want to understand the incremental margin for your product, because your overhead, yeah, you want to manage that. But if the incremental margin, the margin that you make, the extra percentage of a dollar that you make for each additional thing that you sell, that is how you bring the point home to your investors. That is how you tell them, hey, this idea is sweet. Think about Salesforce.com. They make 80 cents on a dollar for everything that they sell. 80 cents on a dollar. That's phenomenal. Google, 65 cents on a dollar for every ad that they sell. So that's what people focus on. They don't necessarily focus on, well, how much was your employment costs and how, that stuff is important too, but your gross margin has to be ridiculously impressive. That's pretty much where you're going to make your money. Everything else is where you're going to spend your money. So you definitely want to be able to show that you're accounting for that and that you're realistic about that. So overhead costs, rent. Let's just say you have this entire crew that travels with you to concerts and you keep them on standby just in case something comes up. A posse, your entourage. You have an entourage expense. You're going to have all these things that you have to pay for, whether you sell one single t-shirt or not. If you have an internet connection, if you use your business phone, if you use your cell phone as a business phone, if you, let's just say you want to wine and dine potential producers or potential business partners, everything that comes out of your pocket, regardless of whether you make a sale or not, is considered overhead. So how do we get to net income? Basically, we start at the top, right? We have our gross profit, which is our first section, and then we basically subtract everything else. So our overhead, our interest, our extraordinary items, which wouldn't really be in most of your business plans, but just figure out, throw that out there anyway, other costs, and that's how you get to your net income, which is it's almost equally as important as your gross margin when you're starting a business. Most people understand that you're going to lose money for the first, at least, for the first year. You might have a tough time. So as long as you can show that your gross margin is strong and that your sales are trending upward, then pretty much the net income problem will work itself out. But if your margins are crappy from the jump, if your margins are horrible, you're not going to make up that ground. So that's why it's really key in a business plan, financial statements, is to show strong margins, because that's what's going to help you kind of close that gap. Once your sales start rising and everything starts working itself out, all of these fixed costs, it's kind of like, think about a graph here, right? Your fixed costs are going to go like this. They should maybe increase just a little bit, just a teeny tiny bit at a time. Whereas your sales, they're going to go like that. So remember calculus, right? Your sales are going like that. This is remaining constant. So the area in between is, growing at an exponential rate. That's what they want to see in your business plan. Yes?
A quick question. If your business plan involves producing content, I'm currently vacillating between hiring a person or as a salary position in order to help produce content, or to hire a person, an independent individual, based on the individual production. In terms of a pitching standpoint, would it be more advantageous to hire a salaried individual in order that your gross profit would be higher per production, or
No, don't fudge the numbers. It is what it is. You hire whatever it is you need in order to get your product off the ground. Now, when you're getting started, you want to be as lean as possible. You want to pay as few people as possible. You want to get as much as you can for free. So if you're going to produce content and you know that it's going to take a while to get you up to a level where you're generating, a sustainable amount of revenue, then it would make sense to probably pay that person, for a certain amount of services, maybe up to a certain point, right? Because you don't want them to price gouge you either. So I would look at that point between, and again, we're talking about break even, right? How many pieces of content is it going to take for this particular individual to break even, right? So if I'm paying them, let's say I'm paying them $100, and for every piece of content they generate, I make $10. It's going to take 10 content issuances in order to cover that $100, right? So what if they're only producing 2 a month? Are you okay with waiting 5 months to break even? Do you have that kind of cash laying around to keep paying them and paying them and paying them and paying them until you meet that number? Or would it be a better idea to say, hey, you know what, things are going to be a little slow up front. We both understand that. So I'm going to pay you per delivery, per thing that you deliver. I'm going to pay you $10 per thing that you deliver. So I'm paying you $20 instead of $100, right? So we're both getting what we need. You're getting your content, and you're also getting your costs reduced. And this individual is getting rightfully paid for their time. So, that's kind of a decision that you have to make, but I would say start off as lean as possible, pay for only what you need. I mean, if you can negotiate maybe an equity arrangement, a sweat equity arrangement where, I pay you even less and I give you 1% of the company, or, maybe 1% of sales, maybe some type of commission or something like that, where I pay you absolutely nothing unless we sell this stuff. So, you just have to have those negotiations with your business partner or vendor there. But I would say keep costs as low as possible. So do whatever it takes. Commission, pay per delivery, whatever it is that it takes. All right? And you can always be nice to them later. You can always give them a really big bonus once you're actually successful. All right, so gross profit is normally expressed as a dollar and a percentage of revenue. It's another term for margin, which I feel matters more than revenue, because if you're going to get $1 for selling, I'm an accountant by trade, so we sell widgets. Tonight we're going to sell markers. So I'm an accountant. I'm looking at your statements, and I'm saying, wow, you sold a marker and you charged $1. That's great. All right, we're good so far. How much did it cost you to sell this marker? Oh, okay, well, I paid a salesman 50 cents. Okay, we're good. I paid, I had to put the ink in the marker before it sold, so I paid 20 cents for this marker. Okay, I'm starting to get a little scared now because all I have is 30 cents left, and we still haven't even gotten to the end of this conversation. So I've done all this to sell this marker, and all I've got to show for it is 30 cents? Well, I don't really care that you sold this marker for $1. I mean, all I have is 30 cents, and your fixed costs are 50 cents. You're losing money on every single marker that you sell. So that's why I like to say margin matters a lot more than revenue. Just get used to that concept. A lot of people talk revenue, 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 revenue. Revenue is great because without revenue, you don't have a business. But once you're getting that revenue in, you really want to focus on your margin, because if it's costing you too much to sell whatever product it is that you're selling, before you even pay your fixed costs, before you pay your rent, before you pay for your entourage, before you pay for your cell phone, before you pay for whatever marketing it is that you want to do for your company, then that's not a viable model. That's not going to last for very long. You're going to bleed cash. Investors are going to see that, and they're going to tell you, good luck, but no thank you. So I like to focus on margin. which I feel matters more than revenue. Operating expenses, again, things that you have to pay for if you don't sell one single thing. EBITDA. Anybody watch CNBC with me? Nobody? Oh, nobody? Well, you'll hear EBITDA tossed around a lot, and EBITDA is essentially a big old fancy word for tell me how much you really made. Tell me how much you really made, and don't tell me about the foolishness. Don't tell me about interest. I don't care about taxes. I don't care about depreciation. I don't care about amortization. I don't care about any of that. At the end of the day, how much cash did you really generate from operating your business? So that's what EBITDA is, and I just like to throw that in there because everybody talks about it on CNBC and the Wall Street Journal, that kind of stuff. So you can kind of start to become familiar with the terms that are related to financial statements. Revenue is actually the physical top line of your income statement, which is why it's called the top line. Net income is the actual physical bottom line, which is why it's called the bottom line. So just wanted to throw that out there for kicks. So any other questions on the data for the income statement? All right. So the cash flow statement, I'm actually not going to show an example of this one because, again, it's really not that appropriate for a business plan. A simple sources and uses of funds will do. I mean, they don't need to see the nuances of, oh, I'm going to make X from my income. I'm going to buy exactly, 5,000 pieces of equipment. I'm going to sell X shares of stock. You don't even know any of that stuff yet. So this statement, I throw it out there because I want you to understand what it is. But in terms of your business plan, it's probably the least important of the formal statement. A simple sources of funds. Hey, you gave me $1 million. I'm putting in my $5. I got $1,005,000. I'm going to use that for marketing, for buying equipment, for hiring a part-time person to help me with whatever, and that's pretty much all you need in terms of a cash flow statement. I mean, that's what suffices. But the formal cash flow statement has 5 components: your opening balance, cash flow from operating expenses, which is essentially your net income plus your depreciation and amortization. The reason why is depreciation and amortization are fake. We made it up. It really has nothing to do with cash and everything to do with estimating the value of whatever that asset is, because assets, at least fixed assets, like this desk, the chair, they go down in value. So I bought it today for $100. The most I can sell it for on Craigslist is $50 now. So we need something fake to account for that difference in value. And that's what depreciation and amortization is. So we add it back because it didn't really happen. Cash from investing activities, cash from financing activities, and your ending cash balance. So again, operating activities, how much money did you earn minus how much did people not pay you this month, plus how much did people pay you that they actually owed you from previous months. So it's a lot different from just saying my net income is $100. If you only received $50 for this month and somebody still owes you $50 from last month and you only received $25 from that, then your cash flow from operating activity is really $75. I don't care what your income statement says. So that's what the cash flow statement is kind of portraying. In terms of investing activities, say you bought new equipment, you sold some assets on Craigslist or whatever it is that you did to raise money for that particular period from equipment sales, that goes in that section. From financing activities, I borrowed money from a bank. I paid some investors. That's your financing section for the most part. Out of all this stuff, the thing to remember is the key points to remember, which are closely monitor the difference between your beginning balance and your ending balance. If you're doing a great job, it should always be the case that your ending balance, the difference between your ending balance and your beginning balance is growing, right? Because that tells you that you're being smart about how you're spending your money and you're making more of it. Now, if...
So it's just like balancing a checkbook for a company?
Exactly. That's exactly what it is. And so if just like when you're balancing your checkbook, right? You thought you were going to have $500 left at the end of this month, and you only had $400. And when you do the same exercise again next year, you say, or next month, you say, you know what? I'm going to do a better job of budgeting so that I can have this $500 left at the end of the month. And this time it says you have $350 left. You are doing something wrong. Either you're not getting paid by your customers, your revenue is going down, or for the most part, your expenses are going up. So You definitely want to pay attention to that difference, because that difference is usually the first indicator that something's not quite going as well as you'd hope. If it's going up, that's great. Let's analyze what's going great, and let's just keep on moving. If it's going down, you need to pay attention, because something is not right. So, all right, so we're going to look at some examples, because I know that's what you're all dying to see. So in terms of our balance sheet here, this is just a little fake simple balance sheet that I put together. Really nothing complicated here. We have cash, we have accounts receivable, we have equipment. Again, I said net of depreciation, that fake stuff that we use to tell us how much it's worth if we sold it on Craigslist tomorrow. And that is basically your total assets. Now, somebody asked the question about working capital. So you see I have cash of $3,000. I have accounts receivable of $500. $500. I have accounts payable of $2,000. So my working capital would be $1,500. That's how much I have left over right now at this moment to cover my, my overhead and those kinds of things. Does that make sense? And in terms of your liabilities, you have your accounts payable, your notes payable, your total liabilities. That comes to $12,000 in this example. Way down here at the bottom, is owner's equity, retained earnings, total equity. And remember I told you how assets equals liabilities plus owner's equity? Well, this is how the formula reads. So you got assets, which are way up there, and then you got liabilities here, total equity there. Liabilities plus equity equals assets. So that's how the formula works. That's the format for a simple balance sheet. And these two numbers have to balance. If they don't balance, you've done something wrong. So it's pretty simple math. It's your decision and the results of what your business in terms of what gets included. Again, this is really simple, but something that you might have in here, again, like I said, that's not in here is inventory. Maybe you sell T-shirts. Maybe you have prepaid concert sales. You know, there are other things. Prepaid concert sales would actually be a liability, because if that concert doesn't happen, you have to give that money back if that's what the contract says. So there's some things that are not in here that might be applicable, but this for the most part should get you through a general balance sheet. Any questions on this? Everybody's clear. You have cash? Does your business have cash? Does your business have anything?
A lot of us are just starting from scratch.
Mm-hmm.
With nothing. So we have like our personal account, so it's like a cash department, but I don't know if that's like I'm asking that, like, if I'm a college student, $5,000 for a business, that in a sense of people on business plan?
I mean, if you want to contribute that $500 to the business, then that's better than not contributing $500, because if that's all you have and you're going to come and ask me for money and not give up some of your own money, then then we're not doing business from day one. Because this is your vision. If you don't want to invest your money, then why are you talking to me? So I would expect, even if you had $500 in the bank, your balance sheet's going to look real simple, but it's going to look a little something like this. It's going to say, I'm putting $250 of my own money because I got to eat. You know, even ramen noodles cost money. Even, you know, water costs money. So I'm going to keep something for me, but I'm going to put $250 into my business. Nobody owes me money. I don't own any equipment. That's why I'm coming to you, Mr. Investor, because I need you to help me pay for all these things. I don't owe anybody any money, but I do have this little equity in my business. It's $250. Right? So you still want to be able to show something. And then, again, when you're putting together your day one balance sheet, you are going to have some things, right? Because if they're going to give you a check for $10,000, what are you going to do with it, right? Remember I talked about your sources of uses of funds, i.e. your little mini cash flow statement. I'm starting with $10,000. I'm going to put my $250 with it. I'm going to go out and I'm going to buy my equipment, right? And when I accept this $10,000, now I owe you money. So now I officially have a full-fledged balance sheet. I got $10,250 in cash. That's what I'm starting with. Let's just make the numbers easy. I'm going to spend $1,000 on equipment. So now I have $11,250 in cash. Mr. Owner, I'm going to give you a cut of my business, but we'll work out the details later. But the equity in my business is now going to go down here. So now you have a full-fledged balance sheet from day one.
So you're saying like if I'm going to you as an investor,
Mhm.
I have 250, I'm asking you for 10 grand. I
Mhm.
should have a balance statement already, assuming that you give me, that's what I'm asking.
Exactly. So if your source of funds, right, you put together your source of funds and you say, this is what I need to get my business off the ground, Mr. Investor. I need $10,000. This is exactly how I'm going to spend it. You know, sources and uses of funds, right? Your little mini cash flow statement. So from day one, here are all the things I'm going to do with this money. Because really they're looking for a day one balance sheet. So it's basically just going to say, hey, I'm acknowledging that I put this business to the money. I spent this much on equipment. I have this much left over in cash. And now we together own, or $10,250 worth in this company. All right? Yes?
Would software purchases be listed under equipment?
Software purchases would be listed under equipment. So you actually buy a license. Well, it depends. Let me rephrase that. What type of software are you buying?
Audio production software.
Audio production software. So that is a long-term license. So essentially, well, I'm assuming it's a long-term license, right? It doesn't actually change from year to year. You're not going to go out and buy new equipment or new software next month or next year for the same exact thing. You might?
2 years tops, yeah.
2 years tops? Okay. I would probably just put that under expenses, honestly. I would just say cash and software expense. Usually if it's underneath, if it's something that you replace, 1 year is kind of the benchmark, but technology is one of those fickle things where something could come out tomorrow and be the next coolest thing and you have to have this to run your business. So I would usually err on the side of expensing a license for software unless it's something just completely unique, something that you developed from scratch, something that's completely applicable to your business, something that you can leverage, or I'm sorry, something that you can use for years and years and years and years and years. That would be an asset. If it's something that most likely you're going to have to replace in a year or so, then that's more of an expense. Yes?
So this is why people are kind of, you told us if it depreciates in a year under you listed as expense or as an asset, and then you have the depreciation in
Well, software isn't depreciated.
how it doesn't, the relative relevance of it isn't.
See, that's what makes software tricky, right? Because software can become obsolete tomorrow. So software, if it's something that you're going to own for, I say you need to put the bar at probably closer to 3 years for software. If you want to be on the safe side always, you would create a line called software license, and then you amortize it. And so it's different from depreciation because, again, depreciation says we usually use this desk for 10 years. And we're going to take 1/10 of this desk off every year because in 10 years we know for a fact that it's going to be worth absolutely nothing. Software, it can be worth nothing tomorrow. It can be worth nothing 10 years from now. So you really don't know with software. So unless it's something that you're developing for proprietary use, let's say you're Apple and you're developing iTunes. And you want to license out iTunes, well, that's an asset for certain, right? That's something we're going to make updates to it, right? We're going to be on version 20 point something or another by the end of the year. But the core of this software and every license that's on every computer in America and around the world for that matter, that's an asset, right? Now, let's just say you're on the opposite side of that and you're buying an iPhone, right? That's a license too. But again, you're going to get a new iPhone next year, right? So, well, Apple's going to come out with a new version, every 6 months, and they're going to force you into buying a new one next year. They'll like zap them all from the sky and make them all die because they want you on like 20G or something like that. But the difference is this can lose value tomorrow. So it's not really considered an asset if the likelihood of it losing value within a short period of time is high. So software, again, it's one of those tricky things. It could go either way. If it's something that you know for certain you're going to purchase next year, or if it's something that's very small in value, let's say I go out and I buy a license for Office for my computer. Most likely I'm going to use it for 3 years, but it's $100. I mean, that's not even worth accounting for. That's not even worth amortizing. So you just kind of have to use your best judgment there. If it's equipment, business cards, expense. Definitely an expense. $250, I got these cards, I'm going to throw them away. Basically, I'm going to give them away to, all the new people that I meet on the streets. That's an expense. All right. Any other questions? Okay, so income statement. Again, very basic income statement, but this is what they look like. You start with revenue at the way top, because that's the top line. And then you talk about how am I going to make my money. I'm going to make my money from CD sales. I'm going to make my money from concerts. I'm going to spend my money producing CDs. I'm going to spend my money producing concerts. And that's my gross profit. Remember, we like this number. We really, really like this number. We particularly like this number when it's nice and strong. Yes?
You were talking earlier about like taking potential clients out to dinner or something like that.
Mhm.
Could you put that on as an expense?
Yeah, it would actually go down here in operating expense. You can create maybe a entertainment budget, you know, a meals and entertainment budget.
That's
And
something that's like tax deductible, like that's really?
yeah, yeah, you can. Well, I don't want to get too technical here, but yeah, that's a tax deductible item. I mean, you can. It's perfectly okay to take potential customers and potential business partners out for lunch or, you know, whatever. Now, it's not okay to take your friends out for lunch and say it's a business expense. That's not okay. But if you can prove that you went to lunch or you really wanted to talk to this person who runs this club or, you know, has this record label, whatever the case may be, you met them for coffee at Starbucks, you guys spent $20 on lattes and scones, that's a meal expense. And that's perfectly fine. So yeah, you would just put another line in there and call it meal and entertainment and save your receipt and document who you met with. So if you have like an email or something like that confirming I'm going to meet with Joe Blow at Starbucks at this time, I got a receipt that says Starbucks, staple them together or scan them into your iPhone into one of your bill payment tools or something like that, and you're good to go. All right, so, you know, we're moving down. We've accounted for all the things that we had to do in the name of making revenue. And now we're going down to the things that just really eat into our pockets and reduce our net income dollar by dollar. We got general and administrative. Again, you got an office manager. You got some salaried people that you pay. Office supplies. I went to Office Depot, bought some Post-its and stickies and whatever. I went to AT&T, got my new iPhone. And then I had to, you know, pay for insurance and all this other stuff, and it cost me $300. I had some travel costs. I wanted to go meet with someone in Mobile or Baton Rouge for the weekend, so I took a trip up, rented a hotel room, drove my car, had some mileage, that kind of stuff. All those are business expenses. As long as it's a relatable expense to this particular business and it's not really related to producing revenue, it goes down in this bucket, which is called operating expenses. So then we total these down here, and we come up with what's called our net income. Now, we want to pay attention to these numbers, right? You notice that this number looks dramatically different from this one. I mean, it's extremely different. So, you know, you want to make sure, again, remember we talked about that difference between your cash, your starting cash and your ending cash. You want to monitor the difference between these two as well. So if your net income is constantly coming in lower and lower as a percentage of gross profit, because remember, this shouldn't change very much, right? Your salaries are pretty much fixed. You're constantly spending the same thing on the same office supplies. Your telephone bill is the same every month. So this bucket should be pretty standard, right? It shouldn't change that much from month to month. So you want to make sure that the difference between your net income and your gross profit, or your net income and your revenue as a percentage, is staying relatively consistent. So that's pretty much it in terms of financial statement examples. Forecasting and projections, as I mentioned, as the gentleman mentioned back here, is probably where you're going to spend the most time in terms of your business plan. But your income statement is the basis for your revenue and your projections. So they go together. They're not two different things. It's just that they look a little different. What I just showed you here is nice and neat and clean, and it's, you know, a two-liner or a two column. What you're going to do for your business plan is you're going to have a whole bunch of numbers. And in terms of your business plan, it really does lie at the heart of your business plan. This is what investors truly want to see is, again, remember we got our fixed costs going like this, but we want to show our sales and our, you know, our margins going like that. And this is the best place to show that. Your forecast and your projections, they show growth and the actual need for capital. Usually projected in 1 to 3 years, so you'll usually do a 1 year, 2 year, 3 year. And then you'll also do it for 24 months. So you'll show monthly from 1 month, 2 month, 3 month, all the way out to 24 months. So it's very, very, very detailed. There's two methods. There's top down, there's bottom up. Top down says, I'm a new concert vendor, and I am going to take over the Howlin' Wolf. And there's only 10 venues in the city of New Orleans. The Howlin' Wolf is one of them. So if I own, or back up, all concert promoters made $1 million last year. And so if I take the Howlin' Wolf, which is 1/10 of the market, I'm going to make $100,000. Sounds good? Wrong. Not for your business plan. For your business plan, you want bottoms up. You want to estimate everything. You want to estimate every CD you're going to sell. If you're selling mobile apps, you want to estimate every app you're going to sell. If you are selling t-shirts, you want to estimate every single t-shirt you're going to sell. You want to know how much is it going to cost for me to make that t-shirt. You want to know how much can I charge to sell that t-shirt. You want that level of detail for your business plan financial projections. And that's why we call it bottom up, because we're going to start with absolutely nothing, and we're going to add on cost after cost after cost after cost after cost. Once we're estimating our costs, we're going to add on revenue after revenue after revenue after revenue after revenue, and then we're going to come up with a detailed schedule for the next year, 2 year, 3 year. And from that point, you can pretty much just estimate, I'm going to grow sales by 20%. I'm going to, grow expenses are going to grow by 10%, whatever the number is. But in this particular business plan, you want to be able to show how you're building those numbers, how you're getting from, I'm this gentleman over here, I only have $500 to my name, I'm going to give you $250, you're going to give me $10,000, we're going to start a business, to how are you going to actually start making money. Does that make sense? All right. So in terms of the bottom-up approach, you want to calculate the actual number of things you're going to sell. You want to multiply that by price, and that number should build over time. I mean, I would love to be Apple and sell 1 million iPads the first day and sell out the second day. I mean, that's great. But we're not Apple and we're not selling iPads. So for the most part, your revenues are going to start off, your sales might start off a little bit slow, and then they'll build up over time. Expenses, you want to calculate the number of items you're going to produce. You want to multiply that times your costs and just make an assumption for monthly operating costs. I mean, you know what your cell phone bill is. You know what, rent is, because you're going to call that studio and you're going to say, how much does it cost to rent this studio? So you're going to make your assumptions, and then you're going to just drop those in for your operating expenses. And this number should grow at a rate higher than pretty much what most people think their revenue is going to grow at. Because it really never works out that way, that your revenues or your prices are going to increase by 1% and your expenses are going to increase by 0.5%. It never works out that way. Usually what's going to happen is there's going to be pressure on your prices, your sales volume is going to go up, and the cost of doing business is going to go up even more. So think about the cost of oil, right? You went to the gas station on Monday and oil was $3.50. Or gas was $3.50. You went to the gas station on Tuesday and gas was $3.70. That's what happens with expenses. Now your paycheck didn't go up, right? Mom and dad didn't give you more money. The government didn't magically give you more money for your student loan. That's how it tends to work in business, right? So they'll make an adjustment at some point, but when you're talking about the day-to-day cost of doing business, your expenses are going to increase at a much faster rate than your revenue. So you want to build that curve based on sales, because that difference between, expenses and revenue is going to constantly tighten. So if you show anything else in your business plan, if you show expenses are going to go down and sales are going to go way up, and instead of remember that curve I was talking about that goes like this, yours goes more like that, that's ridiculous. That's fantasy land. That's not going to happen. That's a complete waste of time. So, just be realistic about your assumptions and document everything. So document, hey, you know what? How did you come up with this number for sales of this, music app? Oh, I got in touch with the developer, or I went to iTunes and I saw that this is how much it costs. How did you come up with this this line item for? Let's just say you're going to pay someone to develop content. I called them and I got an estimate, and this is what they said. So this is how I came up with that assumption for that cost. You want to document your assumptions. And then again, this doesn't have to be in your business plan, but investors are going to key in on your numbers. They're going to rip them apart. And if you show one sign of weakness, that's it. So know your numbers, know where they came from, know how you got there, make realistic assumptions, and just make sure that every decision that you're making in terms of your business plan is documented, and you'll be okay. Now, they're not going to make you sweat, but if you don't know where your numbers are coming from, then they're going to just assume that you really don't know this business as well as you think you do, or you're lying. Either way, they don't want to work with you. So what does the projection look like? I condensed this down, but I wish I had opened my laptop. I can show you one that I did this weekend that took up about, I think I had 86 assumptions, and I had about 40 rows or 40 columns going out. I mean, this sucker was huge. It took about, 4 pages to print it, and that's usually what yours are going to look like. It's going to be very long. It's going to be very detailed. But what you want to take from this is, just like we had our income statement, remember our small little income statement? So it looks and it feels just like that. It has the same category. It has revenue, except this time we're going to be a little more detailed. We're going to show the number of CDs that we sold. We're going to show the price, and then we're going to show the revenue we expect from that line item. Now, you don't actually have to show the number of CDs sold or show the CD price on your actual business plan financial statement, but that number needs to lie in the background somewhere. Like, you can hide it, you can do 2 versions where you link one together. One's a summary version, one's a detailed version, but the number needs to be there somewhere. Same thing for expenses. You want to break down your expenses based on every single thing that you're going to sell. And you don't have to show this level of detail, but it does need to be there. In terms of the gross margin, remember I talked about how your margin number is way more important than your revenue number? So you want to make sure that you understand how much you make from every single thing that you sell. So I know for every dollar of revenue I bring in this particular model, in year 1, I'm going to make 76 cents on every single dollar. That's how much I actually get to put in the bank before I pay for all this other foolishness at the bottom. So that's a key number, right? Because you want to know verbatim with absolute certainty that this number is strong. And this number, while it may go down sometimes, I have in this model, it takes a little, jog down. It may go down, it may go up, but as long as it remains strong, it's going to support that sales volume. So as long as your sales volume is going up, your margins are remaining strong, your fixed costs are remaining steady, you're going to make money. And that's what you want to be able to show in your business plan more than anything. So as you can see in my business plan, which is very short and very simple to the point, I'm making $110 the first year or first month. I put year/month. You're going to have a year version and a month version. And I'm going to make 110, 180, and then 410. So that's what we call the hockey stick model, because it kind of does like this. What's really going to happen on a month-to-month basis is you're probably not going to make a lot of money for the first couple of months. You're probably going to actually lose money. And I didn't want to scare y'all because that's just not fair. But for the most part, this number is probably going to be negative, particularly if we're looking at it on a month-to-month basis. Let's pretend, for example, this wasn't years. This was months. And this represents everything for year 1. Month 1 through 6 most likely will be negative. And that's okay. As long as you show that you're making some progress towards profit, that's what counts at the end of the day. So that's pretty much, that's pretty much all I have. One other thing that I wanted to mention was break even. So everybody wants to know when it's going to break even. So essentially how you would calculate a break even is you would take whatever fixed costs you have to cover. In this case, it would be what, $155 of operating expenses, and you would essentially say, I know that my margin is going to be $265 or 76%. So knowing that my margin is 76%, how many markers do I have to sell in order to cover $155 worth of expenses? So that's essentially what your break even is telling you. If I have to cover these expenses every single month, how many markers do I have to sell in order to cover that particular bucket of expenses?